Hey, so we're working through Module 2, Financial Reporting, Multiple Choice. So question 1, and again I've got both the notes and the quiz up on screen, just so I can kind of show you the process of how I approach these questions in terms of going through the notes. Okay, so the first thing that I want to do is, because we're in Chapter 2, I'm just going to skim down to Chapter 2 in the notes. Okay, so the first question over here is, a company's reporting ends on 30 June X6 and the financial statements are authorized for issue on 31 August 2016. So on 30 July 20X6, a major drop in the share price means that the value of the company's investments has declined by 30% since the period end. The fall in value is material. So we want to know whether this is an adjusting event or not. And that's basically going to relate to whether or not the event was in existence or known about it at the time of the reporting period, so 30 June 2016. So let's do a Control F for adjusting. So here we have it, it's taken us straight to adjusting events. So those events that provide new or further evidence of conditions that existed at the end of the reporting period are called adjusting event. So we need to know if something happened at the 30 June. So basically, like if it's a court case that existed at 30 June, but they just don't know the outcome, and that happens like 2 months later, and they learn the outcome 2 months later, and then that would be an adjusting event because it occurred. Sorry, it was known, but now there's new or further evidence of conditions that existed that we're just finding out. But because this is not a court case, it's not something that, it's not like the decline was in existence as at the end of the reporting period, therefore it's a non-adjusting event. So the two options that we've got for non-adjusting event is this one, a non-adjusting event with disclosure, or non-adjusting event without disclosure. So now let's look through the notes and see in what situations do we need to have disclosure or not disclosure. So let's scroll down to non-adjusting events. So in the case of non-adjusting events after the reporting event that are material, this is the key word here, an entity should disclose in the notes of the financial statement the nature of the event and an estimates of its financial effect or a statement. So we just got to figure out if it's material or not. So 30% and it says it's material, so yes, it's a disclosing event as well. So the answer is B for that reason. Okay, so let's move on to question 2. So during the 20X financial year, ABC changed its policy on accounting for inventory. This did not materially affect the 20X16 financial statements, but will have a material impact on the financial statements in subsequent reporting periods. So here we have a company which has changed its accounting policy. So in addition to the above accounting policy details, which of the following financial information is it mandatory to disclose in accordance with IAS 1? So let's do a Control F for change in accounting policy in our notes. So it says here, the presentation should only be changed when a significant change has occurred in the entity's operation, and that management is the opinion, blah, blah, blah. So this is talking about selection of accounting policies. Here we go, changes in accounting policies. So IAS 8 permits an entity to change its accounting policies only if the change is required or it results in the financial statements providing reliable and more relevant information. So the question is, which of the following financial information is it mandatory to disclose? So we need to figure out what disclosure information is required. So here we have down here, according to IAS 8, when the initial application of IFRS influences the current, an entity must disclose, nope, that's not it. According to IAS, when an entity makes a voluntary change in the accounting policy that influences the current or prior period, potentially a future reporting period, the entity must disclose. Here we go. This is what we need here. So we need to disclose the nature of the change, the reasons why it provides more reliable and more relevant information, the amount of the adjustment, and so forth. So we just got to look through these ones and figure out which of these doesn't fit in with this. So the first one is the fact that the financial report has been reported in accordance with IFRS, and the nature and reasons for the accounting policy change. So we need that. We need the nature and the change. Yep. In accordance, whether there's been a voluntary change might have an effect, an entity should disclose the nature of the change. Correct. We need to provide the nature of the change. And the reason why applying the new provides more reliable and more relevant information. Correct. We need to provide this as per this little bit here. And so forth. So that one looks correct. Let's have a look through these bottom ones just to double check, just in case there's something we've missed in the first one. So there's nothing in here about going concern, so we can scratch that one. This one is the fact that the financial report has been prepared in accordance with the international financial standards. Correct. And the financial effects of the accounting policy changes on subsequent reporting periods. So I'm not seeing anything in there about the financial effects, because most likely you won't be able to calculate that necessarily. So yeah, there's nothing in there about that latter part, so that's incorrect. And D, the financial effects of the accounting policy, again, we just proved why that was incorrect. So the answer is A. Alright, so question 3. So we've got a company here with a profit of $300,000. They got share of total comprehensive income after tax of associates. Sorry, share of total comprehensive income after tax of associates, $20,000. Share of profit after tax of associates is $15,000. Exchange gain on translation of foreign operation up to the date sold, $7,000. Exchange gain on disposal of foreign operation recognized in profit and loss for the year, $21,000. Increase in asset revaluation reserve, net of tax, $45,000. Dividend paid, $10,000. So in accordance with the requirements of IAS 1 presentation of financial statements, what is the total amount of other comprehensive income? Okay, so for this we need to know what is other comprehensive income and what's included in other comprehensive income. So let's do a quick Control F for OCI, or maybe I should do other comprehensive income. Other comprehensive income. So just as a quick recap as to what other comprehensive income is, it's below the P&L, and it's where you put those other items of P&L which don't directly fit into the ordinary business earnings. For example, you wouldn't put your ordinary revenue, you wouldn't put your ordinary cost of goods sold. You're going to put things like revaluation and exchange gain and things like that, which, you know, it might be paper gains or accounting gains or theoretical gains or valuation gains, which generally aren't cash producing items or accounting or the typical business operation accounting items. Okay, so let's just quickly find out where the section of OCI is. So I just did a click here and it came up over here. Statement of profit or loss or other comprehensive income. So IAS 1 states that the components of OCI include gains and losses from the revaluation surplus, tick, gains and losses from remeasurements of defined benefits, gains and losses from translating the financial from Forex, gains and losses from investments in equity instruments designated as fair value through OCI, gains and losses on other financial assets measured at fair value through OCI, gains and losses on hedging instruments in a cash flow hedge, and gains and losses on hedging instruments, changes in the time of value of options. Okay, so if you don't know what half of these things are, that's okay. You don't necessarily need to know it, although we do cover off of many of these in the financial instruments chapter of the core content, so you can check out that video if you want to know. But for the sake of this question, we don't need to know that level of detail. We just need to know what's included in OCI and what's not included in OCI. What I'm going to do is I'm actually going to pull up my other notes, which are available with the financial reporting pack over here, alternative FR notes. So in chapter 2 there's actually this section which is visualization of OCI. So that's your standard P&L. You know, you get your revenue, cost of goods sold, gross profit, all the way down to your profit before tax. Note that we've got share of profit from associates accounted for using the equity method of accounting. So that line there is, we haven't touched on this chapter yet. We'll get to that when we start talking about equity accounting. But that's basically when you own a minority interest in a company without control. So what you do, as opposed to just consolidating up into revenue at 100% and all the other line items at 100%, what we do is we just take our share of net profit. Let's say we own 25% of the business, and the net profit of the business that we own a share in, a minority share in, let's say that's $1 million. So what we'll do is we'll take 25% of that $1 million and just put it in this line here, which is just above profit before tax. So anyway, that's your standard P&L. OCI is, on the other hand, is after P&L, and it's after your profit and loss, and it's a little bit more detailed, and it has more information that doesn't go into your P&L, which are more around your accounting and your non-cash, adjustments. For example, you've got your items which will not be classified to P&L. So you've got your evaluation items, you've got your foreign currency translation items, you've got your cash flow hedging items, which is a financial instrument, which we'll talk about later. You've got your share of OCI accounted for using the equity method. So notice we only include the OCI component. But on the other hand, if there's anything which is sitting in OCI that we need to move out of OCI and into a different one, and we'll talk about a couple of examples a little bit later, we'd actually do them as a negative to the OCI balance because we're retranslating it to a different balance. And then down here we've got our share of other comprehensive income from associates accounted for using the equity method. Okay, so what we're going to do is we're going to set up our work paper kind of like this. And the first thing that we're going to do is we're going to figure out if it's OCI, right? Because these are all the items that have been listed in the question. And then I'm also going to do a category over here. I'm going to say retranslate. And basically what this is saying is we want to convert this. If it's sitting in OCI already, we want to move it out of OCI into the P&L. So it's basically a negative balance to OCI. So let's assume these are all no. The two that potentially we may need to move out of this, like retranslate out. Actually, sorry, I'm getting ahead of myself. Let's focus on what OCI is first. So let's have a look at our notes here, and these are all the items that are included in OCI. So you can either look at this document here, or you can look at the alternative notes which I've got over here, whichever ones you prefer. I'm going to have a look at these notes over here. So for the first one is profit after tax. So we know that that's not going to be OCI, right? Profit after tax is sitting over here in the standard P&L. So we know that's not. OCI from associates. Now that is one, right? I find this a little bit harder to read in the text forms. I prefer to look at this table. So I'm just going to bring up this table over here. So the total OCI from associates, so yes, that would be included. Share of other comprehensive income from associates accounted for using the equity method. So yes, that's OCI. Profit after tax of associates. This one would be no, actually, because you can see over here, share of profit from associates accounted for using the equity method of accounting. So this is actually sitting in the P&L, right? But we might need to retranslate it and move it across. So we'll come back to that one. The reason is because they're giving us this single item and it's sitting in the OCI currently, and we might need to adjust it out. Okay, next is the exchange gain on Forex, foreign ops. So foreign currency translations of overseas subsidiaries. So yes, that is OCI, that's correct. Exchange gain on disposal, foreign ops. So it is OCI, right? But there is something we need to be aware of, is this line here from the notes, which is when the foreign operation is disposed of, which was given us from the question, or the disposal. IAS requires a cumulative amount of exchange event to be reclassified from equity to profit and loss. So we actually need to reverse this out. So this is going to be a reversal here. So we're going to say yes. This should say reversal, not retranslate. And then finally, dividend paid. So that's not, asset revaluation reserve. That's also in here. So if we go back to our notes, asset revaluation reserve is in here as well. so revaluation of land and buildings, for example. And then dividend paid is not in there. So dividend paid is a dividend expense. That's just going to sit in the P&L. Okay, so this is a pretty tricky question overall. So first what we want to do is we're going to go, okay, no, no, so there's nothing in there. Then this one is OCI, yes. So OCI, think about it, it's like revenue, right? Revenue is a credit, so we're going to put it over there. Profit after tax of associates, it wasn't OCI, it was in the P&L, but we need to reverse it back to the P&L. So it's going to be 15,000. Exchange gain Forex, we said that was a credit, so it's going to be equal to that number there. And then exchange gain or disposal of foreign ops, we said that was going to be a reversal, so that's going to be a debit. And then asset revaluation reserve, we said it was yes, so it's going to be 45,000. So what we're going to do is we're going to sum up the debits and credits and then calculate the difference between the two. The answer is going to be 36,000. So that's basically the answer for this question, question D. Alright, so question 4. The following information relates to the affairs of Stu. Oh, I'm just going to move this over here. So it's got trade receivables of 150k, allowance for doubtful debts of 8k. It's got the next year, June 2016, it's got trade receivables of 120k, allowance for doubtful debts of 12k. So during the year, the statement of profit and loss and other comprehensive income showed sales revenue of 500k and bad and doubtful debts expenses of 15k. Bad debts incurred during the year were written off against the allowance of doubtful debts. What is the amount cash collected from trade receivables in the year end 30 June 2016? Okay, so for this question we're going to need to do tier accounts. You might remember these from your days at university, Accounting 101. Basically what it is it's you put in individual lines of a certain account which basically equate to the journals you'd post to get that account. For example, to get cash you need revenue, right? But it's revenue less what you're spending, and that's equal to your cash collected. Same for allowance for doubtful debt. You've got a certain contra asset account which is sitting there ready to impair your debts, and that's made up of several different accounts, like how many like what's your opening allowance, your bad debt component, your bad debts written off, your closing allowance, and so forth. So I've actually pulled together this template in the Excel file, which I'll upload so you can play with. So basically how we're going to approach this is, so we've been given allowance for doubtful debt, and we're going to be given trade receivables. What we're trying to get to is the cash collected. So to get the cash collected, what we're going to do is we're going to start off with our sales revenue on this side. We're going to do our decrease in gross receivables, which is basically the difference between our trade receivables. So if our trade receivables has gone down 150k less 120k, that means we've collected 30k in cash there, which is what we're going to plug in there, right? But just based on the trade receivables going down by itself, how do we know that's due to cash? How do we know there isn't a component that's just been written off, right? So we need to figure out what that amount is in here, what that number is, because we can't get that from the question. They haven't told us. We do know what the sales revenue is, though. The sales revenue is 500,000. Okay, so we just need to know this number here, and we should be able to figure out what the cash collected number is, which is basically the sum of these. So this is the cash collected numbers, and this is the numbers which contra to cash being collected, so negative cash basically. So let's figure out what this number is. Okay, so to figure out this yellow one, what we want to do is fill out this other tier account. So we need to know so we're trying to figure out the bad debts written off, right? So the components of figuring that out is the opening allowance for bad debts, the closing allowance for bad debts, and the bad debt expense. Now the reason we got the bad debt expense is because that's how you get the allowance to begin with, right? The journal for it is debit bad debt expense, credit allowance for bad debts. And it's basically where you've got this almost like a provision on hand where when your debts are eventually do go bad, it doesn't hit your P&L as an expense at that point in time. You're expensing it up front in like a regular kind of pattern. So the opening allowance we know is 8,000. The closing allowance we know is 12,000. we know the bad debts written off is, here we go, the bad debt expense, doubtful debt expense is 15,000. So that's going to increase our allowance to 23,000. That means the bad debt written off is basically the difference between that 23,000 and our closing balance. So we know that's going to be equal to 11,000. It also means that we can now figure out what our cash collected figure is. So we know that our closing balance should be the difference between the 11,000 and the 519 and the 530,000. So the cash collected is $519,000. So that's basically how you answer that question. All right, moving on to question 5. So we've got this company. Following information relates to the activities of DEF. Income tax may be ignored. Cash flows from operating activities is 720K. Decrease in trade payables is 23K. Decrease in inventory 11,500. Increase in trade receivables 24,600. Cash proceeds from sale of plant, which has a book value of 25,000, is 14,000. Increase in allowance for doubtful debts. What is the profit for the period? So what we've got here was we've effectively got a cash flow statement, a very simplified cash flow statement. We haven't got any accounting-based entries here. We've only got our cash flow from operating activities. So the key difference between our cash flow from operating activities and our net profit is just going to be non-cash transactions. For example, depreciation. That's going to be in your net profit as an expense, but it's not going to be in your operating activities because there's no cash associated with depreciation. So it's going to be about working backwards from that starting point. Okay, so we want to work backwards from operating cash flow to get to net profit. So we need a work paper, right? So have a look over here. I've set something up where we've got our cash flow from operations. We've got our items in between, all the ones that are listed in the question, and whether it's a decrease or increase and so forth. And then we've got our net profit down the bottom. So currently this is just a sum, which is just basically doing the cash flow from operations plus the sum of these adjustments less the sum on this side. So we're going to put them on either side depending on where I think they're going to go. So the first thing to note is, generally speaking, if you've got a decrease in a liability, now I'm thinking about this going from net profit to cash flow first. If you've got a decrease in a liability, for example, your accounts payable goes down, that means you've paid money to pay down that item. Now that's completely irrelevant to what's going on in your net profit, right? Because net profit has already established when that payable has, it's going to expense it when it's incurred, basically. So generally speaking, a decrease in a liability means there's a reduction in cash flow, which means there's going to be a difference between your net profit and your cash flow if you're not putting the expense through a net profit, but you're paying it out of cash. So generally speaking, this rule is true. Decrease in liability equals reduction in cash flow. Therefore, if we're working from cash flow to net profit, we need to add cash to cash flow if there's a decrease in liability. So I think the best way to work through these questions where it's a little bit confusing is just to write down a rule, think about it logically. If you agree that makes sense logically, then you can use that rule and you can inverse it as well to figure out the other. Okay, so let's apply this rule over here. So we're saying that this is a liability because it's a trade payable, which has reduced. So generally speaking, a decrease in liability would be a reduction in cash flow. So therefore, because we're working backwards, we want to add this to cash flow, right? So we want to put this in this first column. So our reduction in trade payables is 23,000. Okay, next one is decrease in inventory. Now this one's an asset, so it should be the other way around, right? Because we're decreasing an asset. So therefore, this one should be 11,500. Okay. Next one is an increase in the allowance for DD. Now notice that this is exactly the opposite of this. This is an asset, so we want to do the opposite of this. But hold on, this isn't an asset, this is a contra asset, which is basically the equivalent of a liability. So liability would be over here, but because we are increasing it, it's going to go over there. So how much is it? It's going to be $1,000. Okay, next is the revenue loss on disposal. So where is this currently? So loss on disposal. So cash proceeds from sale of plant, book value of $25,000. Okay, so there's going to be a loss in there of $11,000, which is basically the difference between the book value of $25,000 and this. So we know that there's going to be a difference between what they've received in cash. So what they've received in cash and what they're actually going to record in the P&L, the difference, $11,000. Next is the increase in trade receivables. So that's the $24,600. And remember, this is a asset, so it should be the same as this. And because this one was over here as a decrease, that means the increase should be over here. So that means the increase in trade receivables should be $24,600. Oh, hold on, relax, got an extra zero in there. $24,600. Okay, so our net profit should therefore be $74,100. And you should, like, to check it, you could just work back and do some logical checks and saying, okay, if my net profit is $74,100, if I have a reduction in a liability, right, that means my cash flow is going to be lower than my net profit. So I'm going to reduce this by $74,100, reduce that so it looks like it's working, so we're good. All right, next question is question 6. Okay, this is a more simple one, and it's kind of similar to one of those earlier ones. So it's to do with policy change. So which one of the disclosures is required only where a change in policy is voluntary? So we can go back to our voluntary. Let's do a Control F for that. So here we go down here. So which one of the following disclosures is required only where a change in policy is voluntary and is not required for a change in accounting policy required by IFRS? Okay, so we could do this one of two ways. One, we could use the approach of ruling out items. So for example, if we see this on this list over here, because this says when IFRS influences the change, so these are the things you must do. So if we see this on this list, we know we can cross that out. So for example, if applicable, the transitional provisions that might have an effect on future periods. That's covered here, so it's listed on it already, so that means it can't be that one. The nature of the change in policy, that's listed up here, so it can't be that one. The amount of the adjustment relating to prior reporting periods. So therefore, A is the correct answer. Let's just do one last question and then we'll call it for module number 2 and move on to the next module. So question number 9, the last question, is in accordance with IAS presentation of financial statements, which of the following items must be separately presented in the statement of financial position? Okay, for this one, what I might do is I might bring up the alternative notes because it's actually got this kind of useful statement of financial position breakdown, which shows individual line items, which is IAS paragraph 1, paragraph 54, tells you the exact line items that need to be included on a statement of financial position. So what I'm going to do now is I'm just going to look through here and look for non-financial assets, then I'm going to look for issued capital reserves, then I'm going to look for net assets, and then asset revaluation surplus, and see where it is. So first of all, I know straight away that this one's not going to be included because that's going to be on the OCI or statement of equity, changes in equity. Net assets is also not necessarily going to be on there. It's on there, but it's not specified by 54, paragraph 54. And then non-financial assets, let's have a look through here. So I can see financial assets is required by 54, but non-financial assets isn't required, so it's not that one either. Issued capital reserves, so I can see reserves down here, specified for 54, so that's the answer there. So that's the last question that we're going to go through for Module 2. I hope you found this useful. Otherwise, I'll see you in the next video for Module 3, multiple choice questions.